Cathie Woods' ARK fund is down about 50% or more this year. And what can we actually learn from Cathie Woods? How can we avoid making her mistakes? Maybe we can even profit from some of her mistakes. But let's actually look into the background of Cathie Woods, because I was actually found this quite fascinating. She is a smarty pants. She graduated summa cum laude from USC. I think that's one reason why she actually just gravitated towards investing. She thought, I know everything. I'm one of the best students ever. And she actually was working for the investment bank AllianceBernstein, and she actually was underperforming the market in 2007 to 2008. They didn't like her risky strategy, and they just thought it was risky. So she started her own fund, and it's based on the idea of only investing in the disruptors. So let's actually consider some of the biggest risks that exist from this. But first, let's actually look into some of the stocks that are in her fund. So Cathie Wood's strategy is to focus on the most innovative companies of our time, the ones that are very disruptive. Some of them include Tesla, Roku, Zoom, Block, we used to be Square, Coinbase, Spotify, Shopify, Draftkings, and Robinhood. So let's actually consider first the problem with her strategy of investing in the disrupting companies. The problem I see from her mindset is that she focuses on the thesis of the company instead of the price. She doesn't seem to care that she's oftentimes overpaying for a company with inflated kind of philosophy about what they're doing. Like, as an example, when Virgin Galactic was trading at $61 a share, she was buying it, and now it's around $9 a share. Her view is, oh, this is so cool, you're sending people into outer space, and that's going to be a big new thing, and you're charging a lot of money, $100,000 a seat, so that sounds really great. But unlike a lot of traditional investors, she didn't really care that there's unpredictable revenue stream coming, and she didn't seem to care that it's not even profitable. So her view seems at first is just to focus on has to be disruptive, even though sometimes it's not clear that there's even an industry there. Another example where she has made a mistake, and I actually made the same mistake, she bought Coinbase on the first day it was available for trading, and she paid a top price of like $420, buying it second she could. And the truth is now it's like I think it's $175 a share. So that is a bad strategy, because oftentimes if you're just focusing on it because it's a cool thing and you don't really care about the price, you oftentimes will be overpaying. You don't want, Wall Street loves people who are kind of sucked into something that sounds cool, but maybe it's not really worth that price. The other problem with Cathie Woods' fund is that the only way that this can actually work profitably is that you have to have an extremely bullish environment where people don't really care about overpaying for stock, because in a bull market, people will pay way more for a stock than it's really worth. They don't care if the PE is in the hundreds or even in 1,000 range, or even if there's no profitability whatsoever. But the problem is, once the sentiment changes, maybe people start looking at the financials and say, hey, this doesn't really make sense. Maybe you get a bear market or just a tough market, and then these kind of stocks will be going down way more than the actual index. Like, for instance, her fund is down 50%, but the S&P is only down like 10%. So that shows you it's like 5 times more volatile than the regular indexes, which means that probably a lot of her investors are not happy with this, because yes, they like the overperformance on the way up, but they're not likely to like losing half of their earnings on the way down. So it's a very risky strategy. And another thing about what she does that is really against a lot of investment plans is she buys more of a failing stock on the way down. For instance, I think it was Coinbase that she was buying a whole lot of it in the 240 or 250 range. And there are a lot of other stocks that she has been buying on the way down, and that's actually been part of her style for quite some time. Maybe instead of buying high, if she actually had waited for some of these stocks to drop in the beginnings, he would actually be in a better position. For instance, Warren Buffett, I'm not saying he's the world's best investor, but he tends to be very patient and wait years for the right deal. Whereas I get the sense that Cathie Woods is someone who's a little bit impatient and just likes to buy something because it sounds cool, even though the price might be very inflated at the time. So maybe this is something you should learn, that you should exercise some patience instead of just buying it because the idea sounds really hip and it's a great fad. So Cathie Woods' fund did not exist in the year of 2000, but I can only imagine how terribly it would have performed back then, because you had all of these internet companies that were considered really hot, the next best thing, and they really had no earnings and no profitability oftentimes, and many of them went down 90% or more, went out of business. Even great giants like Amazon went down 90% in that era. So you can only imagine if Cathie Woods' fund had existed in the year 2000, it would have dropped pretty substantially. Now, how can you profit from mistakes that Cathie Woods' fund has made? For one thing, there's actually a Cathie Woods ARK short fund. It actually is up 100% this year. That really shows you that betting against Cathie Woods has been very profitable in these kind of more skeptical times for these super growth stocks. And I think that what this kind of should indicate is that if you take substantial risks like she has, just kind of throw the dart at the high flyers, well, in a very bullish environment where you had the restrictions and giving stimulus money to everybody, and everybody was buying the hot stocks, a lot of them went to the moon. But then as soon as there's talk about raising interest rates, people start to look at real companies that actually perform value and more traditional, and a lot of her stocks are kind of limping along. They're not really doing all that well, and I think that shows you that there's a time and place for all of these stocks. The innovative ones, there will be a time for them too, but it doesn't appear as though that's the case at the moment. So I won't be buying Cathie Woods' fund. I think it should encourage you to think, if you're going to buy some kind of high flyer, you should actually have an exit plan though, because these kind of stocks are not really buy and hold. Oftentimes they crash. Like, I never really believed in Virgin Galactic. I just didn't really see a pretty predictable revenue stream long term, because how many people are really going to pay 200,000 or whatever to go in the rocket? And then it's a very volatile business plan too. I mean, how are you going to actually make sure that's profitable? So I wouldn't be buying that. But Cathie Woods thinks that's a feature. I don't. And so if you enjoyed this video, click like, subscribe, and I'll see you in the next video.